Imagine a skyscraper built on a foundation of clouds. For months, the market has whispered about an AI revolution that will change everything. But the truth beneath the surface is far more volatile. Right now, billions are flowing through the economy, yet a closer look reveals a startling pattern. It's moving in circles. We are witnessing a feedback loop where the winners are essentially funding their own customers to buy their products. This isn't just organic growth. It's a carefully choreographed dance of capital designed to maintain an illusion of infinite demand. If you felt that something is off about these record-breaking earnings reports, you're right. Today, we peel back the curtain on the AI circular investment trap. To understand the trap, you must follow the money from Nvidia to the largest cloud providers. Data leaks suggest a reciprocal arrangement that defies traditional market logic. Nvidia invests venture capital into AI startups and cloud firms, who then immediately turn around and use those same funds to purchase Nvidia's H100 GPUs. This creates a closed ecosystem where revenue is booked on both sides, but real-world utility remains unproven. It's like a baker giving a customer $10 just so they can buy a loaf of bread, then calling that bread sale a sign of a booming bakery business. This circular flow artificially inflates quarterly earnings, masking a dangerous lack of actual enterprise profitability and end-user adoption.
The leaked data paints a grim picture of this synthetic economy. Major players are engaging in what analysts call revenue washing, where capital injections are disguised as customer acquisition. When we look at the balance sheets, we see a massive spike in capital expenditures that doesn't align with the actual revenue generated from AI software services. The infrastructure is being built at a breakneck pace, but the applications meant to run on it are still in their infancy. This creates a massive gap between investment and return. Investors are cheering for the hardware sales today, completely ignoring that the buyers are only solvent because of the seller's own investments. The loop is tightening, and the tension is becoming unsustainable. As we move into the technical reality, we encounter the law of diminishing returns. Recent studies by the National Bureau of Economic Research highlight a terrifying trend. The cost of improving AI models is scaling exponentially, while performance gains are slowing to a crawl. To achieve a mere two-fold improvement in reasoning capabilities, companies are now forced to spend 5 times more on compute and energy than they did for the previous generation. This is a mathematical nightmare for long-term profitability. The brute force method of adding more chips and more data is hitting a physical and financial wall. If the cost of the next breakthrough exceeds the total possible revenue, the entire investment thesis for AI collapses. The visual data confirms our worst fears about scaling. Imagine a mountain where each step towards the summit becomes 10 times steeper than the last. That is the current state of large language models. We are pouring trillions of dollars into a system that requires increasingly massive amounts of electricity and silicon just to produce marginal updates. The NBER data suggests that we are approaching the efficiency ceiling, where the energy costs alone could bankrupt a mid-sized firm attempting to train a frontier model. This isn't just a technical hurdle, it's a financial abyss. When the market realizes that the next big leap is too expensive to ever be profitable, the capital flight will be instantaneous and extremely unforgiving. Infrastructure spending is currently the only thing keeping the tech sector afloat, but it's a bridge to nowhere. Data centers are sprouting across the globe like mushrooms, yet the software layer, the part that actually makes money from consumers, is struggling to justify its subscription costs. We see billions of dollars in GPUs sitting idle or being used for low-value tasks that don't generate a return on investment. It's a classic case of build it and they will come, but the visitors are nowhere to be seen. This imbalance between hardware supply and software demand is the primary indicator of a bubble. The massive gear of the AI economy is spinning faster, but it's not connected to anything productive.
To see where this ends, we must look back at the dot-com burst of 2000. History doesn't repeat, but it certainly rhymes. Back then, it was fiber optic cables. Today, it's AI semiconductors. In the late 90s, companies spent billions laying thousands of miles of glass wire, convinced that the internet would immediately monetize every square inch of the planet. When the revenue didn't materialize fast enough, the companies building the infrastructure collapsed, dragging the entire market down with them.
We see the exact same pattern today in data center spending. The scale is larger, the players are more powerful, but the fundamental mistake is identical: overestimating short-term utility while underestimating the total. In this final phase, we analyze the deeper mechanics at play, revealing how these intricate systems operate behind the scenes to influence behavior and outcomes. This changes everything. The crash trigger won't be a single event, but a realization. It starts when the circular nature of the revenue becomes impossible to hide from auditors and regulators. As soon as one major cloud provider admits they have an oversupply of compute that they can't lease out, the house of cards begins to tremble. We are watching for the moment when capital expenditure is slashed to preserve cash. This will send a shockwave through the supply chain, hitting chip designers, server manufacturers, and power utilities simultaneously. The market is currently priced for perfection, leaving zero room for the inevitable friction of a maturing industry. The hidden truth is that the exit door is very small, and the crowd is huge.
What happens if the leading AI enterprises experience a 20% correction? Given their weight in the major indices, such a drop would erase trillions in paper wealth and trigger a broader market contagion. The 80% of market gains they account for would vanish, turning into a massive drag on passive investment funds and retirement accounts. This isn't just a tech problem, it's a systemic risk. Many intermediate investors are currently overexposed, holding portfolios that are essentially a leveraged bet on a single technology. When the sentiment shifts from fear of missing out to fear of losing everything, the resulting sell-off will be driven by algorithmic trading, accelerating the downward spiral beyond any human control.
Protection requires a pivot to deflation-proof assets. When a bubble of this magnitude pops, liquidity dries up, and traditional growth stocks suffer the most. Investors should look towards defensive positions that have historically weathered tech-driven volatility. Physical gold remains the ultimate hedge against systemic failure, while short-term treasury bills provide a safe harbor for cash as interest rates respond to the cooling economy. Additionally, focus on high-yield, boring companies with actual cash flow from non-AI sources. Consumer staples and utilities that are not tied to the tech spending cycle offer a buffer. Diversification is no longer a suggestion. It is a survival strategy for the coming shift in the global financial landscape. The AI revolution is real, but the current financial structure surrounding it is a trap. By recognizing the circular flow of capital and the diminishing returns of the technology, you can position yourself ahead of the herd. Don't be the one left holding the bag when the music stops and the golden liquid stops flowing through the crystalline structure of the AI economy. Use this time to rebalance, secure your gains, and prepare for a market that values real profitability over speculative hype. The warning signs are everywhere, from leaked data to historical mirrors. The question is no longer if a correction is coming, but whether you will be ready to survive it when it arrives.